Hello and welcome. Today we'll be discussing the current interest rate environment and recent Federal Reserve actions, focusing on how these might impact you and your financial future. Last week, Federal Reserve Chairman Jerome Powell testified before Congress, providing insights into the current economic situation and monetary policy outlook. While there are some positive indicators, there are also concerning trends he addressed. Chairman Powell shared that the economy expanded at a solid 2.5% in 2024, the labor market has showed some signs of strength, and there has been modest improvement in the unemployment rate. However, he reiterated several times that the economic outlook remains uncertain. And Powell cautioned that these positive indicators don't tell the whole story. The Fed's two goals are to promote both maximum employment and stable prices, but achieving this balance is proving challenging. Inflation remains stubbornly above the Fed's 2% target and is ticking higher in recent reports. This persistent inflation is eroding the purchasing power of your hard-earned money, making everyday goods and services more expensive. However, raising rates when required to get a handle on inflation can have negative consequences on their other goal, maximum employment and the economy. Furthermore, Powell suggests that the current economic stability might be fragile. Recent policy changes and global economic factors have created an unpredictable environment, and the Fed faces challenges in navigating this environment. This cautious stance underscores the potential vulnerabilities in the economy despite some surface-level strength. The Federal Reserve has kept interest rates steady at 4.25% to 4.5%, pausing its planned rate-cutting cycle. This higher-for-longer approach means mortgage rates will likely remain elevated, credit card debt will continue to be expensive, and stock and bond prices may face downward pressure due to higher borrowing costs and reduced investor appetite for risk. The Federal Reserve's ability to manage the economy through traditional tools has become more limited, and here's why this matters. When the economy slows down, the Fed typically lowers interest rates to encourage borrowing and spending. However, the Fed's policy rate, called the discount rate, is already quite low by historical standards, leaving little room for further cuts. This means the Fed has less flexibility to boost economic growth during tough times. Using interest rate policy to stimulate the economy may be less effective as a result. This is what we saw in 2008, when rates were lowered to near zero, and they had to turn to unconventional measures such as quantitative easing to support the economy and financial system. This situation makes it more challenging for the Fed to respond quickly and effectively to economic downturns, potentially leaving everyday Americans' finances more vulnerable to economic shocks. These economic conditions could affect you in several ways. Your cost of living may continue to rise faster than your income. The value of your investments could come under additional pressure. Your retirement savings may not grow quite as quickly as you'd hope, since the Fed's decision to maintain higher interest rates is likely to have significant impacts across various markets. Higher rates could put downward pressure on stock prices due to increased borrowing costs for companies and reduced consumer spending. Existing bond values may decrease as new bonds are issued with higher yields. Higher mortgage rates could lead to a slowdown in the housing market, potentially causing price declines. These market responses could further impact your investments and overall financial well-being. Given these risks and uncertainties, it's crucial to consider ways to protect your wealth. Gold has historically been seen as a safe haven asset during times of economic turmoil. Here's why you might want to consider adding gold to your portfolio. In these uncertain times, with inflation persisting, markets potentially facing downward pressure, and the Fed's tools limited, protecting your financial future is more important than ever. Consider exploring how gold can play a role in safeguarding your wealth against the economic risks we face today.